I was sitting in my Wall Street boardroom, and there was a discussion going on about financials in one of the companies. And I didn't really hear the substance of what the conversation was all about, but I heard the accountant, yell out at the issuer, 10Q. So I yelled out, "You're welcome." Anyway, we're going to be introducing the accounting panel. Bunch of friends. These are 4 of the top firms in the microcap market, let's face facts. And what they do keeps everybody, hopefully, out of trouble. And once you start to figure out how very important the accounting role is in the microcap market in every sense of the word, you'll understand how these guys play that important role on the street. So to bring up Friedman LLP, Neil Levine as the moderator. Neil, the floor is yours.
Good afternoon, everybody. My pleasure, and I'm humbled to be back for the 3rd time as the premier event sponsor for the Planet MicroCap Conference here today. I have a bunch of friends, distinguished colleagues that I will introduce, and they can say a little bit about themselves. Drew Bernstein from Marcum. We have Corey Fischer from Weinberg, and we have Ed Schenkein from SingerLewak. Did I get that right?
Oh, you got all the names right.
Wow. Okay. Ed is the only one I met today, so we're doing fine. Anyway, my name's Neil Levine. I'm the co-leader of the Friedman LLP SEC audit practice. Thanks, Drew. I've been in that position for the last 5 years. Been with the firm for 20 years. If you know anything about Friedman, we've been around for 94 years, 1924. I haven't been around that long, but 1924 is a long time. We are in the microcap space. We're in the public space. We're a top 25 firm as it relates to doing audits of public companies. We are entrepreneurial, and yet we have great quality control. Our 2016 PCAOB report showed no deficiencies. We're very proud of that. And with that, I'm going to pass it over to Mr. Bernstein. Drew?
Good afternoon, everybody. I think Corey made the point before that almost everybody in the audience probably works for our firms or have worked with us. So we can actually go right to questions and answers.
Pull the mic closer.
For those of you that don't know me, my name is Drew Bernstein. I'm co-managing partner of Marcum, Bernstein, and Pinchuk, which is sort of the China arm of Marcum. We represent Chinese companies that are public on the U.S. exchanges. We currently have the 4th largest SEC practice in China right now. We have 5 offices, almost 100 people. I spend about 1 week every 6 weeks there, so I commute. I live mainly in New York and on Delta. And it's good to be here this afternoon, and I think we have a great presentation for you. We'll try to give you some insight into each of our expertises, and we'll be around afterwards. Anybody has any questions, feel free to grab us. Corey?
Good afternoon. My name is Corey Fischer. I am managing partner for Weinberg and Company. We are a CPA firm based in Los Angeles, focused primarily on public companies emerging through either an IPO or have gone public recently through a reverse merger or some other type of transaction. This year, we've been very active in the capital markets. I think just in the last quarter, we worked with 3 or 4 of our clients, raised equity anywhere from 20 to 30 million through some sort of vehicle. My background is Before I was an auditor, I also was CFO for a couple NASDAQ companies, so I kind of have a unique perspective on what it's like to be a CFO for a public company, an officer of a public company, as well as an auditor.
Hi, I'm Ed Schenkein. I'm the Denver office lead partner for SingerLewak. We're a, excuse me, a top 100 firm with offices in California and Colorado. My experience is from national firms to my own local firm to back to regional firms. So, but consistent throughout that has been working in the entrepreneurial space up through the investor-backed space. So whether it's VC-backed, PE-backed, or publicly traded, that's been the bailiwick of my work for the last 25 plus years.
Great, thank you very much. So we're going to have some general questions that we're going to be answering about the best practices, and one thing that came to my mind is a live event that we had where we were performing an audit last year on a client, and then we had a whistleblower come to us and said, hey, Levine, nothing that you did in 2016, but in 2017, one of our independent board members was using the checking account as a slush fund. So with that, I'm going to ask Ed to comment maybe on what transparency means and who is really qualified to be on the board and to help advise the public companies.
Sure. So yes, transparency is a buzzword today, but for a microcap company going public, an emerging, growing company in the public space, what does that really mean? And to us, what it means is that you have to be fully prepared for what you're doing out there in the space, because the cameras are on you. You have to disclose. It's not the small, closely held company space, even though it has the feel of the small company, closely held space. You have to be proactive. You have to be prepared. You have to be nimble, and you have to be informed, because you have to stay one step ahead of all of your constituents all the time. And who are the stakeholders you have to stay in front of? Well, first and foremost, you have to stay in front of the regulators. You have to stay in front of your shareholders, your board, your audit committee if you have one. Ops has to be in communication with finance and accounting. Management has to know what's going on throughout the organization so that appropriate communication can occur. I mean, at the end of the day, it's all about communication. And so that's kind of where we start, and it does come from a client selection standpoint. Are you going to accept or retain the client? You're checking off boxes in terms of how well is this company performing in all these different areas.
Right, Drew, did you want to comment on that?
Yeah, 2 quick points. We've actually done some studies in this area, and some of the findings we found are remarkable. Studies and interviews. And actually, 2 basic questions when asked to audiences, the answers were astonishing related to this. Number 1 question, who is principally responsible for the integrity of the financial statements? Do you know what most of the answers are from audiences? The auditors. That's not true. The company is responsible for its own integrity. And the second question, which even my partners get wrong, who's the board of directors, the corporate board of directors? Who are they responsible to? Now, just by a raise of hands, how many people say shareholders? Okay, you can all enroll in Accounting 101 again, all right? No. They're responsible for the health and well-being of the company. Now, I know you're going to tell me the shareholders are the same, but they're not, because most shareholders have short-term interests. Those are very inconsistent with the long-term goals of the company. And the other thing that we found out is most of the board of directors, they really don't have the knowledge or dedicate the time that they need to. We've done surveys from the board of directors on one company that was known for a certain thing, a type of security. When we asked the board of directors, how does the company derive most of its revenue, they said from this security. It accounted for 8% of their revenue. So a lot of the kind of checks and balances that you think are in these companies are not. You're going to invest in these companies, you got to do your homework. The name of the game is due diligence.
Right, thank you. We had a panel before ours, or one before that one, on the Bitcoin and the blockchain. And we were fortunate for Friedman to do one of the only public companies called the Bitcoin Investment Trust. And Corey, I'm going to throw this question to you. What are some of the implications of blockchain, the cryptocurrencies, and the initial coin offerings that relate to the accounting profession? And you could piggyback onto that with all the subpoenas, and if you have your name blockchain in your name for a microcap company, what may happen?
I'll try not to be too repetitive of the earlier panel. I wasn't there, so I didn't quite hear what they said. But we talked about the blockchain. There's really three things that right now, I'll break it up into initial coin offerings, and that's where companies are going out. They are selling or raising equity or cash through the sale of these coin offerings. There's cryptocurrency transactions where a customer may pay a company, or a company may pay another company with the use of these crypto coins. And then there's the blockchain technology, which is an emerging technology that's also referred to as distributed ledger technology, which has its own implications. All of these have their own accounting and auditing implications. Probably the biggest one right now is the initial coin offerings, where the companies are going out and they're raising $1 million, $5 million, $10 million through the sale of these coin offerings. And as a lot of you know, there's been a lot of issues related to these offerings. The SEC has not yet decided whether or not these are sales of securities and whether or not they're required to be registered. The SEC has issued various warnings to a lot of the people investing in these companies. They've issued warnings to the people promoting these companies, even the people that are helping advertise. So there's a lot of concern. But on the accounting side, the real concern to us accountants is that no one really knows how to audit these transactions yet. This is a new and emerging type of accounting. There's been no precedent. The PCAOB, the SEC, the FASB, no one's put out any guidance yet. Just recently, within the last week, a task force has been formed by members of some of the major accounting firms, some of the major, Microsoft and some of the bigger companies, to try to figure this out. But right now, especially for us, the smaller firms, there's no real guidance out there. So if I have a client that's all of a sudden comes to us and says, look, we raised $1 million, $5 million, $10 million in these initial coin offerings, that's really outside of our bandwidth. And I'm not sure where some of these other firms are at, but I know for us, I got to take a step back. We got to wait really until the Big Four figures this out, which I think some of these companies are going to use, some of the Big Four firms that are more in tune doing financial instruments. But it's very, very difficult if your company's planning to do this to probably work with one of your smaller cap auditors. Things like cryptocurrency transactions, companies are trading, buying goods, trading in their currencies. That is a little bit easier to audit. I think there are companies out there that have figured out what to do because there are markets for that. But it's a very complicated area, and I think the point is that before you get into this, before you invest in this, you need to really sit with your auditor and make sure that this is something that's auditable.
Oh, thank you. So Drew, I'm going to ask you the next question. It relates to the China practice, and we've been fortunate enough to be your colleague, partner, friend. We do a lot of work in China as well, and there seems to be a big resurgence, especially this year and maybe the last 16 months or so. So what do you think the factors are that have led this resurgence in the U.S.?
Well, the last couple of years, you have seen a huge resurgence. You have in 2015, there was only maybe 8 IPOs, 9. 16, we had almost 26. 17, there was like 22, including uplistings. There's already been almost 10 this year. But I think the main interest right now, especially for the audience in this room, because I don't think there's too many people in this room that are about to write checks to Chinese companies. And if you are, you're probably better off saving the 15-hour plane ride and just go downstairs. It's quicker. But, and it's difficult. I've spent almost 20 years in China right now, and it's difficult to make a lot of money from Chinese in China. But today it's different because China's about to become the #1 economy in the world. They're #2 right now. And it's not that difficult to make a lot of money from Chinese here. And the interest right now in China is the cross-border transactions, where we're seeing a ton of. The Chinese have been leaders in M&A over the last 3 years. In 16, 17, they spent almost $120 billion in 1 quarter. They outspent themselves in 1 quarter in 16, the whole 15. And there's no audio here, and I actually had produced some charts, which are difficult, for me to show you today, but I printed some copies. But, one of the charts, which I know it's impossible for you to see, but these charts basically show different sectors, but they break out the SOE investment. And what we're finding right now is that most of this is not SOEs. This is all mid-cap money that's being invested. So, and the Chinese are coming into almost every sector. They're the second largest purchasers of real estate right now in the United States. They're buying tech companies. They're buying aerospace companies. I was just in a jet the other day called Cirrus. So it was the newest jet certified by the FAA in the United States. It's a single-engine jet. It's owned by Apeco, which is a Chinese company. So I think the name of the game right now is to figure out how we can best become their advisors here. That's the name of the game. The resurgence, that you're talking about, the interesting part of it that we're seeing is the use of dual listings right now. You've seen QQ360 go back to China, and their market cap was 7 times here, $63 billion. So we're seeing a lot of these dual listings right now. And we're also, in the last 2 or 3 weeks, what we've been seeing is there's been a lot of buzz right now about these CDRs, what they call Chinese depository receipts, because they believe that's the mechanism that might allow the domestic Chinese people to invest in companies like Tencent, Alibaba, and Baidu, what we call BAT. So that may be the back door. And the only other comment, that I hear about China is how difficult it is to get money out of China. And it's kind of interesting to me that the people that tell me that all want to buy real estate. And real estate does nothing for China. That's why it's so difficult to get money out of China for real estate. But one of the things that I did last year is we hired someone to help us understand demographics in China. And one of the things that just really popped out to me, roughly, because I'm recalling the chart from memory, about 52% of the population in China is over 45 years old. They're going to be spending 1.5 trillion by 2020. 17% of the population is between 25 and 45. Ironically, that's the group that's supposed to pay for the other group, so the math doesn't really work. And everybody else is under. That's the driver in education. So by understanding the population, you can start to get a feel for the sectors that are going to be doing well. And those sectors are the ones the government is promoting the global M&A. So it is kind of easy to get money out of China for certain things, but not others.
Thanks, Drew. So talk about money, regarding money raising for these microcap companies, which is paramount. Ed, what have you seen in relation to debt, dilution, ways for companies to raise money? Are there any new ways or for microcap companies to raise money without facing, the vulture toxic spiral,
Yeah, so I'm going to give a little preamble to that. So the construct of a board for a microcap stock is really important. It can't be a friends and family. It's like, what are the characteristics that management doesn't have that the company needs to give it the best chance to succeed as a public company or as a growing company? Some of that is maybe industry expertise, some of that may be public markets expertise, some of that may be capital formation expertise, some of that's governance, some of that's process, on and on and on. With that, you really need to have independent board members and surrounding you that can advise you when those outside advisors come up and say, hey, we have the greatest thing since sliced bread for you in terms of a financing instrument, and they don't know it's toxic. They don't know there's a derivative embedded in it. They don't know how dilutive it really can be. They're just saying, oh, great, that solves the problem of getting a little bit of skin in the door. We'll worry about that. We'll let everybody else worry about how that all comes and gets baked into financials or something like that. And so, I think from a governance standpoint, it's vital to ensure that the company has people on the board, to protect the company's interest. It gets back to what Drew was saying. Who does the board work for? They work for the company. If they're working for themselves, not unlike your little skimming problem, you got to make sure that the right people are in the right seats. We talk about that inside companies. We don't always talk about that with the boards. But these companies, more than most any, need that kind of help. Drew, did you want to say something?
Well, corporate governance seems to be this really boring topic for companies, but it's like one of the most critical things, because for me, I look at it like free money. A lot of companies are discounted, Chinese companies in particular, okay? You look at biotech stocks, those stocks are discounted because you're waiting for this binary event that never happened. Well, Chinese stocks and a lot of US stocks are also discounted, but they're discounted because the investors don't trust the numbers. So anything that you can do to regain that confidence, if you want to be a successful company, you better own 80% of your investors' confidence. If you don't do that, you're going to have a real rough ride. And anything that you can do to recover in most companies, in order to make more, in order for the stock price to go up, you have to make more money. But when your stock is discounted, you don't have to make more money. You just have to correct the problem. And sometimes we've seen in companies, sometimes $200,000-$300,000 of investment, hiring a great CFO, hiring, good accounting staff, getting corporate governance guidance. Sometimes that small investment can recover 10, 20, 30, 50 million in market cap. You can't buy a machine to do that. So paying attention to these things sometimes can make you a lot of money.
Ed, do you want to
Yeah.
still?
Yeah, and I guess the other thing that I'll add to that is that whenever a company is going out to raise money, whether it's debt or equity, there needs to be something to sell. So what is the product or service? What is the benefit to the equity holder or the debt holder? Why would they do this transaction? If it's because you're giving them a spiff, you're not serving yourself, the shareholder, or the future of the company. And so, yes, cash is king, and cash can be short. But there needs to be a concerted plan with checks and balances within this governance mechanism to ensure that the company has the best chance to succeed going forward, with or without any specific financing.
Okay, thank you. So, Mr. Fischer, anything happening in the world of SEC comment letters and/or anything happening at the PCAOB? I mean, when we look at the SEC website, which I love to read and see what's going on there with enforcement actions, what are we seeing almost on a daily basis as it relates to the companies and their accountants and lawyers?
Well, the stem of comment letters and enforcement actions continues at a record pace. 2-3 years ago, 4 years ago, the SEC instituted a policy of broken gate, what they call the broken gate, which was a mandate joint task force between the SEC, the PCAOB, and I think even the Department of Justice and the FBI to cut down all the bad reporting, bad accountants, bad lawyers, and that still continues. There's been a lot of SEC enforcement actions against a lot of our competitors here because of their lack of, they were auditing public companies they really shouldn't have been.
Corey, not here.
That's what I said, not
No,
here.
but not here. Okay.
But there's been, that continues. There's a number of enforcement actions. You talked about governance. I just saw one where a small company didn't have a board of directors, and the chairman decided to take a salary for himself. And the SEC brought an action against that company and against that individual. So it goes exactly what you guys were talking about as far as governance goes, that even if you're a small company, you got to have the governance because it's something that, the SEC takes very, very seriously. And this company now was going to have to face the wrath of, what shouldn't have been an issue if it was just approved by a board of directors. So that continues. The SEC comment letters mostly relate to registrants and the issues that the SEC sees in the 10Ks, the Qs, the press releases. The biggest comment letter, source of comment letters continues to be in non-GAAP measurements, in which, if you're not familiar with what non-GAAP measurements is, it will be taking your net income that you report on your income statement on a GAAP basis and then converting it to maybe a different basis of accounting to be more understandable to the investors. That usually relates to when you have a lot of non-cash charges. It's been a hot topic with the SEC for many years. They changed some of the regulations in the last couple of years, and these non-GAAP measures have become more acceptable. But still, there's been a lot of comment letters relating to them. The SEC has issues. They want, if you're going to use these non-GAAP measures, which I think are great for most of the microcap companies because there's so much non-cash distortion in the income statement right now, that you're able to showcase what your real operations were. But the SEC insists that it has, if you use these non-cash measures, that they, can't have more prominence in the financial statements in the GAAP measures. So it can't be before in your press release or your 10K before the discussion of the normal earnings. You cannot exclude normal recurring charges. Lots of companies may want to, if they have a loss from a write-off of a litigation settlement or one particular bad debt, the SEC does not really think that's a non-recurring. If you've had those in the past, that is not a non-recurring charge, so you shouldn't have those in your charges. Can't have just all the good things. If there's bad things that happen, then you also need to give prominence, take out the good things. So the SEC is still looking at these non-GAAP charges, reconciliations for comments. The other comment letters that we're getting are relate to revenue recognition. Obviously, this year, starting this year, there's the new revenue recognition rules that all of the companies now have to abide by if they're public. There are other sorts of comments really relate to segments. The SEC has really increased the comments as they want to know if you have a segment in your company, if management and how management evaluates the performance of these segments. So that's been a big source of comments.
Yeah, well, I have a question also, but to dovetail onto that. So when do these companies, these microcap companies, typically get these comment letters? Is it after they do an S1, or are we talking about a normal 10K that's filed?
Well, the process is, if you file an S1, a registration statement, it's going to be reviewed by the SEC, and at that time they'll have a chance to issue comments. But all companies, whether you issue you file a registration statement or not, is subject to review every 3 years by the SEC, whether you know it or not. You don't know that they're reviewing it. If they don't find any comments, then they're not going to notify you. But every public company is subject to review at least once every 3 years. If you're an accelerated filer or a big board company, it's probably more.
Right. Ed, you want to comment?
Yeah, the thing I wanted to say was that Corey's conversation about the non-GAAP measures, what kind of gets lost in the conversation with the kind of the explosion of, everybody's version of non-GAAP is that really the company's opportunity to explain what's happened is in the MD&A. And that's where the story can be told of this. Everybody tries to keep their MD&A really short and sweet, but it ends up not telling anything. It just says the numbers went up and the numbers went down, and it doesn't really say why. And when there are one-time events and when there are non-recurring events, that's the place for that stuff to occur. Non-GAAP has a piece of that, but it's not a total piece of that. And so, for the companies out there, I would say, use your MD&A to really tell your story. And use your non-GAAP to show how you align with your peers and how you're operating versus how things get distorted under GAAP.
I've personally never a big fan of non-GAAP financials. I've seen a lot of companies use them, and they highlight certain areas that they would like you to see and not others. And if you look back to a company like Valiant Pharmaceuticals that got taken down, that's exactly what they did. They showed non-GAAP financials of how much money they were making by acquiring all these different drugs and businesses, but they never accounted for all the billions that they paid to acquire them. So I've never really been a big fan of using non-GAAP financials.
Right. Okay, with that, thank you, Drew. We're going to open it up to some questions. Yes, sir.
I assume that many of these microcaps
So the question is, they asked me to repeat, is with MicroCap companies operating mostly at losses, how does the auditors and the management deal with the going concern opinion or issue? Anybody want to take that?
Well, first of all, I think the war is over because there's been a new accounting pronouncement this year that came into play, which put the responsibility for clarification of a going concern from the auditor onto management and the board of directors. So the concept of a going concern was always written into the auditing standards, but it was never part of the accounting standards, which is what management uses when they prepare the financial statements and the disclosure. So that has now kind of shifted the burden from the going concern assessment from the auditor to management and its board of directors. Now, at the end of the day, they got to be the same place. And if the auditor thinks that there's a going concern, that's probably where it's going to end up. Now, how is that determined? It's really based upon the company's working capital, their liquidity at a date and time,
On the burn.
and their historical, use of cash. So if a company is in a working capital deficit and has used cash in the prior years, it's going to be pretty hard to overcome a going concern assessment.
Thanks, Corey. Let me repeat the question. I think you're asking, how does the investor get comfortable or know who the board of directors that management's choosing?
It's more of, are the directors helping fill gaps that management may have and make the company?
Go to the board meeting and talk to them. You see, typically, boards will go after people like when they want to get an audit committee chair, first place they hunt is somebody that came from the Big Four. Because Big Four, most of them have forced retirement in the low 60s, 62, 64. Those guys are pretty much unemployable at that point. So they take jobs as directors and stuff because they came from a Big Four and they have a good resume. But what we're finding is, if knowledge is knowing what to do, integrity is doing it. And there's a lot of smart people out there that just don't have that level of integrity that should be there. And because they have the qualifications doesn't mean they're dedicating the time. So don't depend upon other people to do it for you. Show at the board meeting. Ask questions. How much time do you devote? Have you personally gone through this? And you could pretty much see, because on the type of boards that we've seen, you'll probably know more than the board of directors. And if you see that, you're in trouble.
Thank you, Drew. Next question? Yeah, I think the question is, to sum it up, is what is the MD&A really doing for
Yeah.
management versus an investor or maybe an auditor?
So the MD&A belongs to the company. That's why it's called MD&A. And I don't mean that to be flip. And so management's responsible for that discussion and analysis. The auditors are required to review that to make sure that it is in line with the financial statements that are under audit. My point is that, or my points are that, one, that's management's opportunity to tell their story, and that they shouldn't be shy about telling their story, and they should tell it fully and completely. That gets back to my transparency conversation. The second part of that is your question of how does one MD&A compare to another? I think you raise a valid point that for the investor, for the public, what did the company say in years prior or the prior year versus what are they talking about now? Is there alignment? If they're saying, well, this is what we need capital for, this is where we're going to deploy it, this is where we expect things to go, and to some regard, did those things come true? And then you can go to the shareholder meeting and say, how are you guys being accountable? if I'm the investor, how do I know that what you tell me is going to be monitored, and how do I know that it's going to be fulfilled upon? That's the shareholder's objective in terms of if you're electing that board, you're asking them to step in and do certain things. One of them is fulfill on the plan that they declare they're going to do.
Thank you. Any other questions? Yes, sir. The question is, can Mr. Fischer elaborate a little bit on the revenue recognition statute?
Well, could I elaborate it, just to put it in context? The new revenue recognition standards, which are part of the Accounting Simplification Act, is over 800 pages long. So it's not possible to talk about that if you're interested.
Any industries that it affects?
Most consumer product industries, it doesn't affect it. It affects a lot. There's a big effect. We have licensed technology. Could be on software, entertainment products, movie distribution products. Any time where you're selling a license, big differences. Okay, percentage of completion, long-term contracts, there could be differences. Your standard widget sales, probably not going to have effect. There's also big changes coming in leases next year, which you may or may not be aware of, but leases, which always have been just a disclosure item, are going to be on the balance sheet starting 2019, I believe. So that's another big change. So there's a lot of major changes that are happening. But revenue is, if you've got particular questions, I'd be more than glad afterwards to talk to you.
Thank you. Final questions?
I thought it was my accountant's job to do the MD and Security.
Well, MD&A,
First
as
of
he
all-
said, is management's discussion and analysis.
If it's an independent, if it's an independent auditor, auditors, we don't do anything. We just check things. When we don't touch their books, we can't, give management any advice. We just, theoretically, if they had everything and put it around the table and we could see everything right there, it'd be done.
So what you're saying now is management should discuss, analyze what happened, right?
Correct.
That's what MD is.
Right, so
Well, if you
what is
put-
management's responsibility? Management is responsible for the financial statements. The CPA auditor performs an audit on those and then puts a report on it that says that they are reasonable in accordance with GAAP,
It's actually,
and that the 10K belongs to the company. So management and the board, in their oversight, needs to ensure that they have the resources available to ensure that they're compliant. So your SEC counsel, your CFO or your contract CFO should have industry knowledge, GAAP knowledge, SEC reporting knowledge. If they don't, that's one of those gaps you need to look at filling.
well, I can tell you one of the first questions. If you're a mid or MicroCap, one of the first questions that's going to be on that SEC comment letter is who in your company prepared these financial statements and what are their qualifications? And, no, you're going to get, if you're a mid-cap or a micro-cap and you're new, one of the first things in the comment letter, the SEC comment letter, is going to be a question to you. Who prepared these financial statements? What are their qualifications? And who do you have at the company that helps you implement SOX? They don't send that letter to the auditors.
So that brings us to a close. Thank you very much. I want to do this for another hour. Oh, okay. Thank you.